name is Casey with Hill Financial Group, and this is Money Matters. So I'm coming to you this week solo, and we're going to talk about rebalancing in volatile markets and smart moves to take with your 401k during during inflation cycles. So we kind of want to start with just kind of what is rebalancing, what's the purpose of it, and kind of start there. So portfolio rebalancing is really just when your percentages inside your portfolio or you're in different sectors throughout the market. You may start with, let's just call it, say, 10, 20, 25, 15% in various areas. And go throughout the year, certain of those sectors have increased 5, 10, maybe 15, 20% in a particular year. And we don't want to be too overly allocated in one of those sectors. So we need to rebalance the portfolio to bring it back in line to what our original intent was, because we think that's the best, mix of funds to give you kind of the potential best outcome, depending on risk tolerances and various things. So that's what rebalancing refers to, and so that's why you would want to rebalance, is just to bring those things back in line. And so we sit down with our clients and we review that, especially with your 401k plans. Even though we can't directly help you manage that, if you can come in, log in, we can see kind of how you're allocated and what your various options are, and just set that up. And a lot of 401k plans have kind of an auto rebalancing feature that you can kind of take advantage of. But if that's not something your particular plan provides, then we can kind of help you with that when we do your annual reviews and different things like that. So in an inflation environment, kind of like we've had over the past few years, there are certain sectors that are more inflation sensitive. And so this could be where we want to reduce allocations in that particular sector. And so we will come up with a different percentage mix to, kind of hedge off, some of the volatility and the downturns that could happen during an inflationary environment. So that's kind of, one factor to consider, that we take a look at and want to make sure that you're allocated appropriately. As far as, what are your, common mistakes during volatile markets are just making too frequent rebalancing and changing, based on short-term market movements. So we can, sometimes look at, certain sectors or certain areas where we think, the trends or market in the economy might be headed in a particular year. And so we want to, maybe move into that, kind of sector of the economy, or, think where we think, there might be downturns in certain sectors. So we want to get away from that. And so we're constantly looking at your portfolios and trying to make sure that we're allocated in the appropriate spaces and not allocated to the spaces where we don't want to take on that risk in a particular, kind of business cycle or economic cycle or stock market cycle. These are all things that we, would take a look at and try to consider. But I do get a lot of questions about, what about market timing? Like, should we, take a look, or should we, when the market has, dipped, kind of, we've had a little bit of volatility with our Iran situation right now. So is now a good time to buy in? Should we, just kind of lump sum our contributions for this year? Or should we continue just to do kind of the dollar cost averaging? And so, those are all case by case conversations, and try to, there's not a one size fits all to those answers and responses there. But I do think just kind of having an annual or every 6 month, rebalance of the portfolio makes a lot of sense, versus trying to time the market and jump in and jump out. That strategy never seems to, you can maybe hit it once or twice, but you're not going to hit it consistently. And so having that, automatic and that auto save. We're contributing each month, no matter what, market's up, market's down. We're just going to do that, and have that approach. Also on the rebalancing side of things. And so we're going to rebalance no matter what, every quarter or every 6 months or annually, whatever we think the appropriate, timing of frequency of that is. And so the other question that we've got here is when to consider reviewing your allocations. And I think I've kind of hit on this a little bit, just kind of as I've been talking through it. But major life changes, especially, say, you're just getting started, you're kind of in the growth phase. And so we want to be more aggressive. We want to be allocated to, more of the stock market growth funds, so that we're, trying to get the, long-term approach, best returns that we can while we're young. And we're not going to be able to use this money until we're at least 59 and a half. And so we're going to try to get the best rate of return over a long period of time that we can. Maybe you're, kind of in your middle, kind of season of your career. And so you've got 20, maybe 15 years of, work under you, and saved, a good amount into those 401ks. And so now it's time to rebalance into more, value stocks, or, where we're still getting good, consistent returns, but maybe we're not looking for those high flyers that are getting 30-40% a year, where they could also lose 30-40% a year. And so we want to kind of rebalance into something that's a little bit more stable, but still gives us, good growth opportunity there. Or you're getting into your late, maybe you're 5 years out, 3 to 5 years out from retirement. And at that point, we are getting ready to, needing to rely on these savings to produce the income that we need. And so we want to be, much more conservative, and kind of, any volatility that could be experienced during, those, final years of your working life. We want to preserve, a lot of the portfolio there. So we're going to be, taking all those factors into consideration when we're making these rebalancing, and just trying to figure out when is the best, time to rebalance or reallocate, depending on what's going on and what season of life you're in. But always, when we're looking at, rebalancing, inflationary environments, all the different things that we're looking at the market cycle. We're looking at your retirement portfolio, and seeing, kind of where we're at. Are we on track? Are we kind of ahead of schedule? All of these things, but the biggest thing is we just need to be disciplined, take a structured approach, take a very systematic kind of look at what are we doing, why are we doing it, and how is it going to best meet your goals, and what we're looking forward to accomplish. So this is, kind of the 411, if you will, on, rebalancing and why we do it, what approaches you can take to it, and why it could benefit you in the long term. So this was Money Matters with Hill Financial Group. I'm Casey Harding, and we'll see you next time.